Alrighty, hello everyone, and welcome to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. It's always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, lots of exciting topics to get into for this session. We had the JOLTS or the jobs report to come in a little better than expected, but still seems that consumer confidence out there is a little bit weaker. We have the looming possible shutdown, so lots of interesting topics, as I said, to get into. So let's go ahead and kick off. Robbie, out there?
Hey, I'm Zach. Hey, everyone. Welcome to Trade Finder Live. Hope you're having a good start to your Tuesday or halfway through your Tuesday. And let's talk about those reports. The JOLTS report is basically job openings. It was a little bit better than expected after being pretty weak last week, but is it enough to take the Fed off of worrying about the jobs market? We had the consumer confidence number that came out and it was a little bit worse than expected. To me, that's a bigger deal. I guess they tie together, right? Because if the consumer's worried about their job or not feeling like they can improve their current employment situation, they're likely not to spend as much. And we are a consumer-driven economy. On top of that, we had the Chicago PMI that was really weak, one of the weakest in I think like 20 years or something, but it's been weak for a while. So manufacturing in Chicago just hasn't been great for a long time. So I think that report probably gets overlooked, but the key number is 50. Anything below 50 indicates contraction. Anything above 50 indicates expansion with those numbers. And it was down at 40, which is pretty darn low. But again, that's been weak for a number of months. So I don't know how much that factors into it. So, um, I think we're kind of status quo as far as the Fed. We still have 50 basis points between now and the end of the year priced into the market. And unless we get data that makes it look like that's not likely at all. I think we continue this move here in the S&P, which is just a real slow crawl to the upside. We're managing to maintain above this 10-day moving average. I'll go back to this zigzag. I showed that in the U.S. market update. Hopefully everybody saw that over the weekend where we are at the 100% extension. And notice how well these fib levels, that's why I talk about them all the time, act as support and resistance levels. When you have a, call it 61.8% B wave correction, you go up to 100% extension, and that's where we hit. But you also know that oftentimes within a wave three specifically, you'll get an extended C wave, which means it moves to the next fib level. And that's 161.8. And that gives us roughly about a 675 target on the S&P. So as long as we stay status quo, in other words, that it looks like, pardon me, we will get those other rate cuts that, again, the market has already priced in. I think we can continue to crawl higher. Where the concern would be is if we were to, I'll leave this arrow on here, even a test of the 50-day moving average is okay. It's right in this area here of support, right there at the top of the A wave. And so if we were to break below that and the 50-day moving average, that would tell you that that zigzag is complete and that we're probably coming back down to the B. When a zigzag completes, it usually retraces the C wave move. So again, we don't know for sure, pardon me, if it's complete or not yet. But if it is, we'd be coming all the way back down here, which is just the normal course of LA wave and how you would expect things to move. But the market's going to do what the market's going to do, and we'll just see how that continues to play out. Some of you may have seen on YouTube. If you haven't, I invite you to go watch it. The LA Wave haters video that posted on our YouTube channel at LA Wave Options. And it's a little bit tongue in cheek, but basically it's to talk about. I have three main points there that I feel like those that are negative on Elliott Wave are missing. And one of the main things that gets talked about all the time is the relabeling of Elliott Wave, the fact that the charts will relabel periodically. For some reason, that upsets people. And then they joke that, well, Elliott Wave's never wrong, it just relabels. Okay, well, we all know the market is king, right? The market is always right. The market's never wrong because we're trading against the market. So we have to follow along with what the market does. But the market's dynamic, it's not static. The market is ever changing. So if you have an indicator that changes as rapidly or as quickly after a market change, how is that not a good thing? How is that a bad thing? So I just feel like people look at that wrong. So there was some comments on the U.S. market update about it, and I thought I'd bring up that video. May not change your mind if you're an Ellie Wave hater, but I've been trading with it since 2001, and I still wouldn't be using it if I didn't feel like it worked. Now, nothing works 100% of the time. No indicator does. But again, the market's right 100% of the time. And we want indicators that are quick to change with the market. That's what helps us give just a little bit of an edge. And that's all we're looking for because we'll never get it right 100% of the time. So back again, hanging above the 10-day moving average here. And do we get a break of that wave three? If we can break this wave three high, then I think that pretty much tells us that we are extending in that C wave of the zigzag and we're going to 161.8. But we got to do it first. And today, really not much is going on. You can see this tiny bar right here, lower intraday volatility than what we've had. Let's go straight to the VIX. And even though the intraday volatility is a bit lower, we are trading back above 16 on the VIX again. And when you look at this big, huge descending triangle, it reminds me a lot of the triangle that we had in GLD. And in other words, it was very long in forming. Now the triangle on GLD was symmetrical. This one's descending. And a descending triangle does not necessarily mean we're breaking to the downside. Either triangle can break either way. And you could certainly make an argument that the likelihood or the path of least resistance would be a break higher. Because if we do break lower, I don't think it's going to be a big significant break. We might crawl down to this 12.5 level. That's where we spent last summer for the entire summer down at 12.5. So there's a lot of support there. So we wouldn't get too much of a spike down, I don't think. But if something unforeseen were to happen, like a black swan event, I think that's what could create a big movement to the upside out of the VIX. So keep an eye on that. And then if we go straight to the dollar, and then we'll look at the bond market, the dollar is helping. It's being super cooperative, especially with everything that's going on. When we started this breakdown, and that was coinciding with the bond market that I'll show you in a minute, seemed to at least leave the door open for a potential 50 basis point rate cut at the last meeting. We didn't get it, got 25. So the bond market has been correcting, and so has the dollar moving back up. So now we're back in this Goldilocks channel here. So the dollar is lower, and as the dollar stays lower, it helps companies with international exposure from the exchange rate, et cetera. And it seems like at this point in time, once the next earnings cycle rolls around, I think earnings will be pretty decent. But do we have a correction before that? Or does that come at the top and we get a buy the rumor, sell the news type of thing? I thought that was a possibility with the FOMC meeting, that if they only cut 25 basis points, the market would be a little bit disappointed since the bond market seemed to be leaning, at least protecting against a 50 basis point cut. So we didn't get that. We got what was expected, but there was no sell the news yet. So we continue to watch this. We've kind of broken out of this ascending pennant pattern going to probably take that off at some point because you all know what the market's been doing there. And getting old seeing those lines there. I like to change up the charts periodically with what's currently going on. But if we tick up much from here, we're right back in that ascending pennant. And, if we do get to 675, that's a pretty darn extended wave three. We've had all of these zigzags here, zigging and zagging all the way to the upside. And just that's why I like zigzags when in a wave three, because they give you potential targets. We're still in the buy the dip mode. Every dip in this wave three has been bought. And curious if it was going to happen again after the dip that we had at the end of last week. And certainly not an aggressive buying spree, but we didn't have any follow through to the downside. So let's take a quick look at volume on the S&P, and you can see it's kind of coinciding with what's going on in the market. We've got pretty much the same size bars on the buys as the sells. So on the up days and the down days, the volume's about the same. What happens when that occurs? Pretty much what's going on right now, sideways. And that's what's happened ever since we hit this 100% C wave extension. Nothing since then. For about 2 weeks now, since we hit the 100% extension, we've been hovering at that level, trying to decide if we're going higher or not. And if you wonder, well, the longer we stay there, which way does that lean? It leans a little bit towards an extension. Normally, when you have the C wave hit its target, if that's immediately going to be the end of that zigzag pattern, the retracement starts pretty quickly. So slight nod, cautiously optimistic is again, I think where you should be psychologically with the markets. The longer we stay here, the better chance of breaking up, I believe. So let's just go ahead and jump to the bond market. We'll look at TLT. As a reminder, this is prices on the 20-year for those of you that may be viewing for the first time, those of you that watch it over and over again. You've heard that a million times, but I think it's important to point out for our newer viewers, prices and yields move inversely. So you can see prices are moving up on TLT, which means rates are moving down. Why? It seems that the bond market feels, and here's that breakout of this triangle that we had on TLT when the bond market was at least getting prepared for a potential 50 basis point rate cut, because with prices going up that much, yields kept coming down. And then we had retracement of that kind of vertical move, and we held right at the wave one high and then turned and have headed back up. So maybe the bond market just got a little bit ahead. Wondering if maybe the 75 basis points could come earlier than expected, which would have opened up the door for rhetoric on will we get more than 75 basis points by the end of the year. I'm not convinced that we're going to get 75 basis points. If you listen to what the Fed is saying, there's a lot of FOMC governors, and this is not Alan Greenspan's Fed back in the day, where you never heard from any of the FOMC members other than Alan Greenspan. He was the one that was out in front, and he was talking. He used to show a cartoon with my little rant that I would do on the Federal Reserve, where it said Fed speak, and it showed Alan Greenspan, with one of those little bubbles of gibberish coming out of his mouth, because there used to be the big joke that Alan Greenspan would talk and say a lot, but actually say nothing. So he would speak a lot, but it made no sense, just talking around things, and nobody ever really knew what was going on. Far more quiet, secretive Fed back then under Greenspan than we've had since then with Ben Bernanke, and moving forward ever since then, Chairman Powell now. Let's go look at the TNX, because I know a lot of you like the 10-year, and we're seeing kind of roughly the same thing. You can see this tick back down in rates here. So rates are going down across the yield curve, and that's not necessarily healthy. It's flattening out the yield curve, which makes you wonder, is the economy okay? Is it maybe a little bit weaker than what we expected? Um, with the fact that it's flattening back out. And what that means is that rates are pretty stable across the yield curve from the lower end to the higher end maturities. And when it steepens, that means that you have lower rates for shorter term maturities, higher rates on longer term maturities. That's healthy. That's normal. You should gain a higher interest rate for holding a bond or security longer. But now, if you've been trading in T-bills or um, bonds, etc., you've been better off to take the shorter term maturities and keep rolling it over. And you can compound money much faster that way. So that's not how it normally works. And we do have a pretty decent setup here on a five-wave Elliott wave pattern on the TNX with that wave four right at the 50-day moving average and right at a fib resistance level of 38.2. Are we going to get rates to move that far down? I don't see the 10-year coming all the way down here. Maybe it does. Just like I don't see the dollar or don't want to see the dollar move all the way down to the 90 level. You've heard me say that numerous times, and everybody keeps asking why. What would that mean? The dollar's been down here before. You look at a monthly chart, that's why that line's at 90. It's a support level. It's also at the bottom of the tap box. But I just feel like things are different now as far as the view around the globe of people being concerned about the amount of debt that we carry here in the U.S. And I think that has helped put a bid under gold, an amazing move higher in gold. We talked about this big triangle. That's what I was referring to before when we were looking at the descending triangle on the VIX. This was the symmetrical triangle I was mentioning on GLD, and these were the two targets because any triangle can break either direction. So you had to allow for it to go up or down. And those were the targets based on the triangle rules. You measure the mouth of the triangle, and then you go from the point, and the price level moving higher is your upper target, the price level moving lower is your lower target. And not only did we break that, but then the AI, and if by chance you haven't gotten a copy of this software, if you've been under a rock or you're a newer viewer or whatever, you can go to hub.com, hubb.com, and get a free copy of this software. All the charting is free. All of the Elliott wave signals are free. You do have an opportunity to subscribe to the AI signals if you'd like, but you don't have to. We talked about Top Shot as a way of getting one alert per week out of the four portfolios that we have, the level three plus the speculative. We can get one from there. But with level three, you get likely multiple alerts rather than just one. So it's a way to take a look at the AI signals if you're interested. So when we look at this AI signal on GLD, it said, now you're not going to stop at 330. You're coming up to 337. And it was right. 70% chance that we were going to go there. And then we just pegged there for over a week. And then we've taken off again. And it's mind-boggling to me that we're seeing this kind of move in gold. It's pretty vertical. It's pretty extended. I felt like back here when we started this consolidation that some more backing and filling here was appropriate. Maybe even coming back down and testing this 337 level. But we had a few days of the backing and filling and then gapped up again. So it makes you wonder, what is GLD seeing? What is gold seeing that maybe we don't know yet? And back to that black swan thing I was talking about. Or maybe it's just getting in front of, with lower rates coming, the dollar's likely to go down. Usually when the dollar goes down, gold goes up. But clearly you can see gold is going up way more than the dollar is going down. The dollar's been down here for months. So I don't know. We'll see what's happening, or maybe gold's just playing catch up to the fact that the dollar has been weak for a while. Silver's been kind of right in the same boat there, getting a bit vertical. And the AI came out and said, it is going to play catch up. 72% chance that SLV hits 44. We got a little bit overbought yesterday, pulling back a little today. I'd kind of like to see us come all the way back down to that 10-day moving average, because if we do, then that's a pretty nice trade. Right now, it's just a couple dollars move from where we are, and I would rather see if $3 or $4 potential movement higher. But again, the market doesn't always give you what you want. In fact, it rarely gives you the ideal scenario or what you'd really like to see out of the market. That's why you have to be quick to react to whatever the market does do. Then if we move to the cryptos, interesting thing here is that gold is moving higher, maybe on the expectation. I'm just speculating, but maybe on the expectation that the dollar goes lower. But one of the reasons that there's been this new embrace of cryptos from the early days of cryptos of at one point in time, we are likely somewhere in the future, I think it's way off, but some point down the road, we're likely going to move to a digital currency. That seems to be where things are going to go. And it used to be widely accepted that it was going to be Bitcoin. That was going to be the one. But now you have people talking about Ethereum, even Solana. There's other players now in the crypto space that could be the one that's pegged to um, the digital currency. The administration likes XRP. So there's several different things other than Bitcoin. The positive here over the U.S. market update, I was talking about if you're long Bitcoin, at least as evidenced by the BITB, and I keep saying this every time too, because a lot of you like IBIT, both of them very liquid in options, both of them with the options, a good leverage way to trade in Bitcoin, better than just buying partial coins, in my opinion. You just have the time aspect of it, but you can go a little further out in time if you want to negate that some. But we had BITB down here at 60 to end the week, and it needed to hold that. It's a test of the B wave right now. You can see it didn't change it. We didn't take out this low. And if we had, then we were looking at maybe 55 on BITB. But yesterday we had the big move up, and we're consolidating that move today. All three of the major moving averages are all together. So we're not out of the woods yet, because we basically have a qualified downward zigzag. I call this the dueling zigzags. It's fun when we have this kind of a scenario, because now you can look at this as a potential downward zigzag on BITB. So which one wins out? This is kind of one of those times where you go on pause. You've got two qualified zigzags, both of them, interestingly enough, with the 61.8%, both of them were very strong B wave corrective levels. So at this point, there's really no way to know which one's going to win out, at least not from a technical standpoint. And then I mentioned Ethereum, and we're kind of building in. We had the stair step pattern where we went sideways, vertically up, sideways, vertically up, sideways, vertically up, and now more of a consolidation here. And it looks like I had it as a smaller before. I'll just go ahead and move this line, a smaller descending triangle, but with that move down, they got bought into. I think you can bring this line down here a bit and say that it's a larger descending triangle. And once again, a descending triangle does not necessarily mean a downside breakout, but it does mean that we're going to get some sort of a break from this consolidation pattern in Ethereum, likely in the not too distant future. And we have no idea what direction that's going to be. So interesting times in the crypto space. Another time where you're just kind of like watching, maybe not jumping into trades at this point in time, just kind of watching until we get a more definitive signal on which way things are going to go. I think that makes sense. Then if we move to energy, UNG just tantalizingly trying to get that oversold bounce. You've heard me talk about this numerous times. Uh, Natural gas is caught in a supply demand dilemma. We have so much natural gas. We are the Middle East of natural gas in the US. We know there's demand coming from the data centers. The electrical grid can't hold it. And the administration is kind of negative on solar or wind power. What does that leave? Natural gas. But we don't know how much natural gas is going to be used. We got to get the data centers built and then see what the consumption is going to be. So I'm not looking for any sort of a big takeoff run in natural gas, but this has been one heck of a move lower. And so at some point in time, the sellers get exhausted, the shorts get exhausted, and you get a again, path of least resistance bounce um, back up because it doesn't take many longs to move it back the other direction when the shorts are tired or exhausted. So we're going through this consolidation here right around 12 and a half. We keep trying to get above that 50-day moving average. If we can, then I think maybe we get up here towards 15, which is all I'm really looking for. Again, just that oversold bounce or exhaustion of the seller's bounce. But every time it tries, it's been turned back. We're trying again. What happens this time? We'll wait and see. And then if we go to oil, oil kind of wanting to sneak out of the downside of that symmetrical triangle. Another one that's quite similar to the triangle on GLD, and you saw what that move was. So looks like we're going to get some sort of a move here on oil, at least as shown by the USO. Don't know which direction it's going to be. Had a false breakout here. You could probably make an argument that that's just a larger triangle. The reason I haven't redrawn this line is this high did take out this one. But I wouldn't argue with somebody that said, oh, well, this is just a bigger triangle. Draw the line out here, and maybe oil consolidates for a little bit longer. Again, I'm, drawing trend lines and triangles, etc., is a little bit subjective. So I wouldn't disagree necessarily with anybody that felt like it's just a larger triangle. But we'll just wait and see which way things are going to go. But some sort of a move is coming out of USO, and I think it'll be a significant one. If we do break to the downside, pardon me again, my question is, how long would it take OPEC to flip the script on what they've been doing, which in the past, anytime we had one of these spikes up, they increase production. They don't want oil to get too high in price. They don't want to drive a whole new breed of drivers, consumers into electric vehicles, but they do want to keep the price elevated because they want to make as much money as they can on the amount of oil that they have in the ground. They've done the geological surveys. They know that they're starting to run out. They're trying to manage that supply demand curve, similar to what I was talking about with UNG. And so far, they've done a pretty good job. They've been able to peg it right towards 75, as you can see there. So that's where I was talking about. If we did break to the downside, how long would it be before OPEC cut production to prop the price back up? And that's going to be interesting to see how far down they're willing to let it go before trying to manipulate the price a bit. All right, so that covers the metals. Let's go to the other U.S. market updates. We look at the DIA here and note that that's in a wave 5. When we look at the SPY, we're in a wave 3. You'll see that 2 markets are in wave 3s, 2 are in wave 5s. Which way do we go? I know there's been some talk that don't know about this wave 5 in the Dow. It could relabel to a 3, no doubt. But when there's a comment that there's no rule of alternation, if you don't know what that is, that's that if you have a mono wave 2, you're going to have a complex 4, or vice versa. but the wave two and the wave four can't be both monowaves. So when I look at this chart, I kind of feel like there is a complex wave four. So if I spread it out, I'll show you what I mean. When we look at this in the wave four, to me, that's a pretty good zigzag right there. There's the A wave, the B right up to 61.8. I mean, right at 61.8, which gives you 100% extension, and we almost hit it spot on. So I think there's an argument to be made that that is a complex wave four with that zigzag in it, and maybe this wave five is correct. Maybe that's the one that wins out as we move forward. Um, Normally, when you have the two markets, the SPY and the Dow, having different Elliott wave counts, they come together at some point in time and tend to agree. You can see there's similar patterns with the DIA moving higher and the S&P moving higher, both of them just kind of creeping higher. Um, but the relabeling will likely occur here to where they agree on the Elliott wave pattern at some point. But it's not that unusual to see them labeled differently. It's just usually after that they come back together and agree. And then we go back to the Qs, another wave three in the Qs like the SPY. So the Qs are similar and same pattern here. We ran up, we've gone sideways, holding above the 10-day moving average for now. Is that wave three over? Or are we going to start the wave four correction here? We could start down in the markets with both the SPY and the Qs and the Dow all going down, with the Dow maybe being the end of a wave five and starting down in the corrective phase, where the SPY and the Qs move down in their wave fours for corrective phase. But I do think that we'll see the patterns label to where they're in a similar fashion. And then we look at the IWM, and that's another wave five. So two markets in a wave three, two markets in a wave five. Which one is right? The Russell is a little easier to predict, I think, because you just watch interest rates. It's the most interest rate sensitive of all the markets. Again, as a reminder, they're small caps, they're smaller companies that need to borrow money to grow and expand their businesses so that they become mid caps and then hopefully large caps at some point in time. Obviously, that's the idea when you start a business, but they need capital. And as rates go down, it's less expensive to borrow. And so that's why the IWM tends to move with rates. Even it's consolidating a bit in this wave five high that extended 114%. So which way does the markets relabel? We'll wait and see. Do these two fives from the Dow and the IWM relabel to a three? Possibly. Does the SPY or the Qs relabel to fives? Possibly. So really hard to know at that point, but you just trade them for what the rules are based on their individual markets. A negative here is the one market that is kind of breaking below the 10-day moving average right now is the IWM, but just barely. We did that at the end of last week, got back above it. We're breaking back down below it today, but one day means nothing. As you know, you have to have a follow through or confirmation day. If we did get the IWM tomorrow to follow through to the downside, if indeed we close there, and we still have time before the close, and we get follow through, then once we break this low here from Thursday, then maybe that tells you that we are in the corrective phase following a completed wave five on the IWM. But we can't say that today. Maybe tomorrow we can say that, but we can't yet today. So that covers all the markets. And at this point, we'll go ahead and open it up for questions, Zach. I did want to show our case study from last week, which was on the uranium ETF, expecting that maybe to play a little catch up with gold and silver. It's in a wave three. 70% chance that it comes up here. So far, so good. A little bit of consolidation here following these three big updates that we had there, and there. And so we're consolidating that, but staying nicely above the 10-day moving average. Still feel like that has a reasonable chance of going up to hit that target. So I don't see any reason to change that scenario. It's the only open case study consideration that we have in TradeFinder right now. All the rest of them have been closed. We've had such a good run in TradeFinder over the past few years, and then we'll see how this one plays out. We'll add another one to the mix today, and Zach will be back just before the end of the session to talk about that and show you how to place it. So we'll save that till the end. And again, Zach, take any questions.
Yep, sounds great, Rob. Let's get right into it. Got a question here from JJ. Any thoughts on how the impending government shutdown is going to affect the markets?
Good question. And I meant to mention that in the beginning. So thanks for asking the question. I was going to give my opinion for whatever that's worth. I think it's all political theater. We know that. I mean, they always talk about it being scary. Even got a message from my bank saying if you're a federal employee and the government shuts down, contact us. We have some programs to help you, etc. It's amazing to me because it's a foregone conclusion. They're going to raise the debt ceiling again. They fight over their points. They all get their 5 minutes of airtime arguing their points. The Republicans have already said, "All right, we'll deal with the tax credits for Obamacare at another time." And I feel like if it's not an 11th hour, which it normally is, an 11th hour agreement that's placed, I think in the past, all I can remember is one, maybe two times where the government actually shut down, and it's just for a day or two. Um, but it does uh, make headlines for the media, etc. But my opinion, from my experience, I wouldn't be shocked to see an agreement made at the end of the day to day before the official shutdown occurs. And even if we are closed for a day just to make a point, it doesn't serve any politician well, and they all know it with their constituents, regardless of which party they're in, because they all blame each other. It doesn't serve well for any of them to actually have the shutdown. They can all do their posturing and, we're not budging and all that stuff so they can make their points and get their talking points and their airtime out to their constituents. But in the end, both parties want to keep the government open. And I don't feel like it's much of an effect. Now, if we had something different, and the market can always do something different, and the government did shut down, once again, I don't expect that to happen. But if the government did shut down for an extended period, yeah, that's going to create some volatility in the market. Maybe that creates a spike in the VIX. Maybe that starts the corrective phase in these markets. It's always a possibility. I just don't think it's likely. So we'll see how it plays out. Uh, but in the past, um, it's just all political theater every time this comes up. That's my opinion, but we'll see what actually happens.
Very well. We shall see indeed. A question from Hector. Can we check out BCFS?
BCFS. Um, is that correct? B is in boy, C, F is in Frank, S is in Sam. I don't see that symbol.
Yeah, that's correct. I'm looking at what that is right now. It might be an OTC.
Yeah, that
No,
would
it
have to
says
be.
it's on the NYSE. It's Bain Capital Specialty Finance, BCSF.
SF. Okay. I heard you say FS. I don't know if that's what you said or if I
Yeah,
heard
I
it
think
wrong.
that's how I read it to you as well. So
Okay.
Apologies.
No worries. So breaking down, which is interesting to me, and I think this has to do with individuals. There are some financials that are doing well, and normally when you move into a rate cutting cycle, that's a positive for financials. But there are others, in addition to this, that are breaking down in charts similar to this, and that break below 14 and a half there is significant because that was not only support, it's below the 10-day moving average, and it would seem that this wants to come down and test those April lows. So that's not a good scenario. It had a chance at the end of last week and even the beginning of this week to get back above 14 and a half and the 10-day moving average, and it didn't do it. So seems like perhaps a little bit lower, just somewhere in that area. Maybe looks like where it's headed. But then it'll have some, I mean, when you get down to those April lows, with that being such a pivot point in the market in general, that would be a pretty good area of support. So I don't know if that's enough of a move down to try to short this stock. Maybe it's better to just watch and wait, see if it bounces off that level. And just as a final comment, if it does come back down here, it would be a real short-term bounce. So if you're super aggressive in your trading, then maybe you try a long bouncing off of this area of support. But the more conservative approach would be to let it come back up and get back above 14 and a half. And once it does that, then we're probably back into this channel that we've been in with the highs around 15 and a half. So you could have a move there from 14 and a half up to just above 15 and a half. So yeah, it is interesting to see. It tells you that some of these um, financials are not as healthy as others.
That's a fact. And next up, we have a general question from Green Emerald. Do you also look at the NASDAQ?
Um, yeah, I mean, I usually use the Qs because most people trade those. Um, and we can look at the NASD. We can look at the NDAQ, whichever you prefer. So we'll look at that for the NASDAQ itself. This just kind of tells you how much those um, Mag 7, some people have moved it out to 10 stocks are affecting, um, but the overall NASDAQ, which is quite a bit weaker than the Qs, as you can see. The algorithm has labeled this, and just as a note to those of you that may be new, because every now and then somebody will post on the US market update that they don't agree with where I put my LA Wave labels, and I just want to be clear. I'm not the one that's putting those labels on the chart. The algorithm does. It's an algorithm built into the software that's programmed as Ralph Nelson Elliott wrote it. So the software itself labels it based on the algorithm, not I'm not personally putting these. I just do my best to interpret what the charts show. And we do have this wave 4 in purple, which means that the algorithm thinks that could be it. It's at a fib level, right at the 38.2% fib level. If we can get back above the 10-day moving average, then perhaps we can start talking about, pardon me, the NASDAQ itself moving back up in the wave 5. But first things first, and the first thing is get back above the 10-day moving average. And if it can do that, then yeah, maybe we start looking at the NASDAQ itself going higher. And you can make a case for this. I've talked about, I called it last week, the radical rotation. And the reason I call that market rotation occurs um, just at some point in time, um, institutions do look at fundamentals and technicals as well. And when you have just a few stocks that have been driving the market with the AI stuff, um, once the valuations get so high, and they're pretty high right now, um, institutions will start looking for, okay, where is a sector that's been performing well, and what are the stocks that have been underperforming? And the viewpoint is that if the sector as a whole is doing well, and there's not some sort of nefarious thing going on with an individual company, institutions will rotate money there because they feel like they get more bang for their buck in that catch-up phase that I was talking about, where some of the rest of them that haven't been the leaders, they don't have to run up to the level that the leaders did, but normally they play a little catch up and get a little bit of a bounce. And perhaps if this wave five does to start coming towards fruition here on the Nasdaq itself, it's because institutions are broadening out where they're putting money. They may take money out of some of those big tech stocks and find some of the other stocks on the Nasdaq that are doing better. Good question.
Yeah, thanks, Rob. Question from Will. CRWV, where would a good entry be?
Well, yesterday would have been a good entry because you can see what happened today. And they signed a deal today that I forget how much money it's worth, but that gave it the bounce off 125. That was the area of resistance we've been talking about. We didn't really get an actual follow through day on the bounce of 125, but then that deal was announced today. So that's put the bid underneath it, at least for today. So at this point in time, I wouldn't chase that move necessarily. We want to see where it closes. Does it rebound and close up near the high of the day? Does it fall back down and close near the low of the day? That matters when you have one of these gap ups. So the ideal scenario would be a test of 125. Get some water. Fill this little gap, test support, test the 10-day moving average. That would be an ideal entry. Again, the market doesn't always give you the ideal scenario. If it continues higher without that test, then breaking this high here from August would be your entry. And perhaps at that point, you're looking at a test of the highs back up around 175. But let's see how it closes today, see how much weight the market gives this deal, and if there's any follow through higher or if we head back down. But anyway, yeah. Good on you, Will, for mentioning a stock in the news today.
Indeed. Question from Barbara on SoFi. Dropping like a rock, what to do?
Yeah, it's in the same mode with some of the other financials, but in fairness, SoFi had one heck of a run. I mean, it came from in June, it was a $12.50 stock, and it went up to 30. So almost a triple in stock price, almost a 200% gain there on this move in the wave three. So here's the C wave extension, 50% B wave correction, and the 100% extension. And as I was talking about before, oftentimes in a wave three, you'll get 161.8% extension. It looks like that's not going to be the case here. This looks like that's the end of the C wave, which again hit its target at a 50% B wave correction. And this is kind of what I was talking about earlier. Forget the stock we were looking at, where we could be heading back down to this B wave, because when a zigzag ends, it retraces the C wave. So we go back to where the B is. Pretty rough day today, and maybe we continue down just a bit on it. But yeah, it certainly appears that there's going to be no extended fib level on this, at least not now. The one positive that you have is the wave three is still green. So it hasn't turned purple yet. The algorithm, even though we're moving down, is not fully convinced that that three is over and that we're creating a four. So even if we came down and retraced this C wave on the zigzag, or at least test the 50-day moving average, we could still turn and go higher. But for now, it looks like, at least in the short term, maybe tomorrow we get a little bounce because this is an ugly day today, but perhaps a move back up. So, when you're seeing some of these financials that are all over the map, some doing better, some not doing so good, it's certainly not blanketly that all financials are doing well, with the expectation, at least, of future rate cuts. Um, it seems that at least some stocks are pricing in maybe we don't get the 50 basis point rate cuts and it becomes a tougher road for financials. I think SoFi is reacting to that consumer confidence number being a little bit weak. If consumers aren't confident, if they're not um, feeling good about their jobs, then they tend not to borrow. So just like we were talking about, small caps need to borrow money to grow and expand. Consumers like to borrow money and spend as well. And if the consumer is not all that confident, then this is what happens to financials like SoFi that are kind of dependent on the consumer spending. So, yeah.
The second question from Will is going to be on CRWD.
CrowdStrike. And, you're just amazed that this hasn't been doing even better than it has. You just feel like, there's more need for this, Palo Alto, et cetera. And we tested that big round number of 500 again, which was where we hit the highs in July. We're going through a nice little consolidation here. And Will, I'm sure, as long as you've been around, you're already seen this. It's consolidating here in a bit of a triangle. It's not the biggest triangle in the world, but it's not horrible either. So it looks like there's about a $25 move, breakout move coming on CrowdStrike. But as you know, we have no idea which way that's going to be, which direction it's going to break out. But certainly looks like about 25 points coming one way or the other on CrowdStrike.
Thanks, Rob. A couple of symbols from Alex. First one's going to be TTD.
Yeah, I like this one. We looked at this one before. I feel like this is a place where perhaps we could see some rotation, because of the fact that it's gotten beaten up and went sideways for a while. It was in our sideways AI search to drop. It did go sideways for a while. It was only a 44% score, so it was too low to initiate any sort of an alert. But it went sideways for a while and then broke down. So it kind of did both things. When you have a higher score, you expect it to stay in a trading range about this long. And when it's a lower score, it has the possibility of going sideways, but also the possibility of breaking to one of these boundaries. And this one did both. There's a support level that I've drawn here that it's been holding so far. It's back above the 10-day moving average. I think that institutional money, especially moving into the end of the year, where they're chasing performance. Just a quick chat about that is, money managers get paid on beating the S&P. That's how they get their bonuses, which is where their big money comes from. And so if there's an investment manager that is underperforming the S&P, man, they are chasing that performance to try to get back above that so they can get their end of the year bonus. And the way they tend to do that is they look for opportunities like this. Where's a stock that's been really beaten up, that's a pretty decent company, and can make up some ground in a short period of time. I think this is a candidate there, as long as it holds the 10-day moving average. Ran into a little resistance here with this sideways consolidation, really not unexpected there. And if we can break above that, hold the 10-day moving average, get above this level around 52, then maybe we have something going there. But I find this one quite interesting as well, and it's on my watch list also.
Second symbol is going to be AVGO for Broadcom.
Yeah, good old Broadcom. And stock that didn't participate early back in here, but then after the April tariff tantrum low took off and has just really been performing well. Um, all the rules we talk about, filling gaps, vertical moves, likely come vertically back down, too far from the 10-day moving average, you come back down to it. All that stuff has happened with Broadcom. Had the big move on earnings, backing and filling going on here. So the backing is kind of going sideways. The filling is when it comes down and fills part of the gap. I don't know that we're going to come all the way down and fill the entire gap at this point in time. Perhaps it does, but that would be if the market does roll over and start to correct. Then perhaps that happens. But in the short term, looks like maybe it wants to test the 50-day moving average. It got pretty far away from it when it got up here to this wave 3 high. It has turned that purple, so it feels like that part's done, and this is a corrective phase. We've hit the roughly 23.6% fib level, so that's why this 4 is labeled and it's green, because it could come a little bit lower. So I expect Broadcom to likely test that 50-day moving average, and then we'll see how it handles it from there. If it gets that close, does it just tick down just a little more and fully fill the gap? That could be a good entry if the market does continue its melt up. But I think this is another sign of money rotating into other areas because some of these valuations have just gotten awfully high. And then you have that aspect of performance chasing from investment managers.
Alrighty. Thanks, Rob. I see we're right at time. Still got lots of questions for you, but in effort to time and still getting to the case study consideration, is it all right if I pass one more symbol through to you and then we'll head over for the case study?
Yep, sounds good.
All right, let's check out Palantir, PLTR for chance.
One of the market favorites, extremely high valuation on Palantir. All kinds of controversy around this company, but the market has loved it. We came back down here and had kind of the dueling zigzags here as well. And we've been managing to hold above this level. We've taken out that B wave so we can take this potential zigzag off. It was qualified, but now it looks like continued move to the upside. The market's not tired of this stock yet. It's getting awfully close to the tractor beam, which would be a move up to that big round number of 200 there. Doing a nice job here of holding above the 10-day moving average as it consolidates under that wave 5 high in August. I think if you're super aggressive, you could take a shot at this one now, as long as it stays above the 10-day moving average, because if it doesn't, it's coming back down to 170 real quick. But as long as it stays above the 10-day moving average, again, if you are aggressive, you could dip your toes in the water now. If you're a little more conservative, just go ahead and wait for it to take out that wave 5 high. Yeah, and this is where it all comes down to, right? Risk reward. That's what the markets are all about. And if you take a little less risk by letting it break above that wave 5 high, you get a little less reward, because then there's not too much room left before it hits 200, which would be a point of resistance. And if you step in now, you risk that the resistance holds and then we turn and go back lower. So I think be nimble on this one if you're wanting to step into it. If you're already in it, at this point, I don't see any reason to exit, and I would follow along with those other guidelines that I mentioned.
Alrighty. Very well. Still got lots of questions for you, but I note that we are over time. So if you want to head over to the case study consideration, by all means.
Sounds good. And we are going to do the TTD that was asked about. Yeah, I think with a market that has some uncertainty in it now, the risk to reward here makes sense. Um, so we're going to look, um, no AI scores or anything along this. This is just going along with that potential for some market rotation, trying to find a stock that could jump up rather quickly. They're not looking for any sort of a big run back to the highs, but just again, like I was talking about with UNG, very similar scenario of an oversold bounce here, back up to that 50-day moving average. So this would be a nimble one. So we would look at a price target of 55 here on TTD. So that's going to be our case study consideration this week. Pretty speculative, um, without a whole lot of significant technicals behind it. But just in that, it might be just a hair early for the performance chasing, but we're about to move into October. And that's when, after the third quarter, that's when investment managers start really looking at their performance and trying to create a plan of what they need to do to get ahead of the S&P returns, if they are indeed below it. So that's going to be it. All right, Zach.
Very well. And is that going to be an official idea for this week?
Um, we're just going to make this one. There's just not enough to make an official idea, so we'll just do a post here.
Very well. All right. Just wanted to clarify that. So I'll go ahead and take the screen over real quick and go to the platform to post the post. You should be able to see my screen now. And so here we are at a menu view, a jumping off point of the platform. We'll go up here to this right toolbar over to the light bulb for ideas. As we just confirmed with Rob, it's going to be a post for this week's session. And in this space, it would be viewed as kind of a discussion board, as the criteria is not fully met for it to be an official idea, which can be equated to paper trading. So we will come back and make this look extra pretty as soon as the session concludes. And as I always say each week, for whether it's an official idea or a post, whether you agree or disagree, we welcome your opinion. And of course, just add your supporting evidence and be considerate of the ever-growing community that we have. Opposing opinions is what makes markets. If there was all buyers or all sellers, there wouldn't be any transactions, any options, any open interest, liquidity, all that good stuff. So whether you agree or disagree, we welcome your opinion. Always love to interact and see the, again, growing volume and users, subscribers. But be short and simple for this week, as it's just a post. And as I said, we'll make that nice and detailed right after this session concludes. So I'll pass back over to you, Rob.
Sounds good. I'll come back and look at this screen as we move forward. And I do want to second your comments. I love the social media aspect of this platform. I think it's fantastic. And in this age of so much negativity and various social media platforms, I've been really impressed with the respect that people do show with opposing views. We learn from that as well. You have an idea, you go through your thoughts, your process, you post it. Somebody may come up with something that you hadn't thought of, and you're like, it's actually a good point. And the comments, even in disagreements, have been really respectful. Hub sends me a notice every time there's a new person that joins the social media aspect of the platform. They're adding people every day. It's continuing to grow, as Zach said, and I think it's an amazing addition to have that aspect on top of a charting software program. So once again, if you haven't gone to hub.com and get you a free copy of this. So with that, thanks for taking part of your trading day out with us. We very much appreciate your time, value it greatly, and we have a couple hours till the market closes, and we'll maybe have a little bit more information on some of those charts we looked at today tomorrow to see if we get follow-throughs or not. So thanks again for your attention. Look